Hi everybody, this is David Skrika. So this is our part 2 video, and what we're going to talk about here is, in this video, is trading techniques you can use. Now, in our first video, right here on Addicted to Profits, you can see we talked about kind of the history of the markets in the last 17 years. I talked about the LTCM boom and bust, and the reason I started with that is I really think that was a key turning point in markets where the Fed became actively involved in bailing out companies, basically also targeting asset prices, and then Greenspan really helped to juice the market in like 99. Okay, so we have that boom and bust, and then that turned into the real estate boom and bust, and then that turned into now the international debt bubble, where after the real estate boom and bust, all these interest rates are being artificially suppressed. We have this kind of bubble in stock buybacks, bubble in biotech, bubble in emerging market debt issuance, bubble in stuff like high yield credit in energy and other sectors. So basically, money just sloshing around. Basically, what this bubble is all about is the search for yield, because let's face it, with the kind of deficits we've seen, even in a deflationary environment, we probably wouldn't see these rates here at 2% or whatever. So this has also led to AAA companies being able to borrow. Like something like J&J yesterday, they only beat their earnings number. Remember, their revenues were down gigantic, for a large company of their size. They only beat their earnings number because they bought back a lot of stock, and that inflated their EPS. So we have this like financial engineering bubble. You might say that's okay, fine and dandy, Dave. We have bubbles in all these sectors. So how do you make money off it? So I'm going to show you in this video. This is kind of how I think. Okay, when I saw there was last year, I figured when the Fed was tapering, you would actually begin to be able to make money on the short side. Okay, and so I'm going to show you how I kind of look at things from the long and short side. So we've had this biotech bubble going back the last few years, and if we go look at a 10-year chart or 11, 12-year chart of the biotechs, put it on a linear scale, we can really see this parabolic blow off here, right? And we see this kind of bust here, and so when I saw this, and I figured the Fed was tapering last year, we could start to look at shorts. I actually didn't really attempt to short any biotechs last year, other than maybe the biotech firm. But what happened earlier this year were there these like Canadian pharmaceutical and biotech companies that really started to spike higher. And the thing about it was, this is where you learn from your experience in the past. And I remember in 2000 when the dot-com bubble burst, the stocks that fell the most weren't the big U.S. stocks. Okay, Amazon, Yahoo, these companies all got hammered. But what really got hammered, there's all these small Vancouver internet stocks that popped up. And these are real speculative things. When you get these small microcaps happening at the end of a bull market, that's really the sign of the bubble. So this is CXR.TL, this is Concordia Healthcare. This is a stock which was a penny stock in 2013. And when they did their reverse transaction, basically the stock went from $4 to $117. So I shorted this in the late 90s in our service. It's fallen over 50% in the last month while the market's actually rallied. So this is kind of what I'm looking at right now, and this is kind of how I think. I was thinking, okay, we're in a biotech bubble. The Fed is not in the way anymore. Probably these small cap Canadian stocks are going to fall even more. And this is another stock I shorted around 850 or so. This is Noblessa Healthcare. This is another Canadian healthcare stock. And you can see this is down about 30 to 40% as well, right? So this was kind of my thought frame of thought, was that these companies can't do buybacks. They're very small micro caps. They're probably where the most speculative part of the bubble was, and you can make money shorting them. So that's kind of how I look things at the short side. And then we look at a stock like SWKS. Okay, this is a stock I've talked about many times. I'm short. This is actually a Wall Street darling. Everyone from Charles Payne on Fox Business to Jim Cramer, they all love this stock. Okay, and this stock kind of sums up how I look at shorting and buying put options and things as a whole. Okay, SWKS basically has gone up from 20 in mid-2013 to as high as 112 based on the fact that it's a supplier for the iPhone 5 and 6. It makes chips. It makes a lot of the chips that connect you to the 3G and 4G networks, okay? So this basically discounted that. So I was like, if we're at the top of the iPhone cycle, and this happened to Apple back in 2012 when the 4 was released and all this sort of thing, and Apple actually went down almost 45%. And you can see SWKS went down about 40% too, from from 31 to 18 to 19. This company has probably discounted most of the cycle at this point. So if it discounted the boom in the 6 here, it's going to discount the topping of that cycle here. And while we saw a good surge in the 6S with the slowdown in China, with probably a lot of people not going to be really upgrading to that phone this quickly, I think you're going to really see the sales of the 6S taper off. And the better way to play it, you can be short Apple, that's fine, but it's probably through the suppliers. And we've seen actually, remember, SWKS has the largest percent of its sales to China of any company in the S&P 500. So that's also factored in with the Chinese devaluing the yuan. And even if these are just suppliers they're selling to, those suppliers, if they're buying in yuan, it's gonna cut SWKS. And if they're buying in US dollars, they're probably gonna buy less because their yuan buys less. So they're really going to be hurt by that. And then and this is kind of one thing that makes me really unique in shorting. We look at SWKS from a technical standpoint, okay? There's been numerous booms and busts. This company started trading in 1984, and in the late 80s was kind of this bust in microchips after the big boom for the first video game systems, personal computers, the first Macs, the Commodore 64s, these sort of things. And you can see during that bust, SWKS went from $6 to $1, went down over 80%. The next real boom bust in biotech was, of course, the late 90s, and this stock spiked and went from 77 to 3. Okay, and even during this pullback here, this stock went from 37 to 13, and we can see it looks similar to how it did in the 90s with this huge parabolic move. So regardless of what they sell, SWKS just seems to be kind of a fringe chip company that booms and busts. So that's why we bought put options. We also have a short position here in the late 90s. We probably bought but we really nailed this one. We really bought our put options when in the mid 50s. I've sold some, took in some profits. They actually, during the big kind of flash crash day in late August, SWKS, it really moved very well. It tanked really well. They moved, I think they went up about quadruple. So I took some off the table at that time. And I still own some, which are basically profit right now. And we're going to see what happens on the earnings later this month. But this is kind of my thing. I'm looking for a company, because of the iPhone 6, difficult year-over-year comparisons, has a history of boom and busts in the boom bust cycle in the semiconductors, and a stock that was universally loved, parabolic chart, is going to have, in my opinion, a tough time going forward. And then the bonus is all their exposure to China. So this is kind of how we think. And the thing, the beauty of a stock like this is, well, the market going down could help. Remember, this stock went from $6 to $1 during the big boom in the stock market of the 80s. In just a correction in 2011, it went from 37 to 13. So this is the kind of stock that, because it's going to be dependent on its fundamentals somewhat, obviously the bubble in stocks in 13, 14 did help it, but could probably fall on its own. And remember, the market, the S&P, isn't even down 10% right here. And this stock is down almost 30% from its highs. So that's kind of the way I do it. So that's kind of the way I think on the short side. So a lot of you might say, hey, Dave, shorting's just not for me. It's very difficult, put options, all this sort of thing. How can we make money? Well, right now I still think you have this kind of scenario where the markets can continue to decline, and gold and precious metals are seeing multi-year bottoms. So we look at the hedge, okay? This is an ETF that I'm telling people to buy in the $10 to $11 range here, okay? This is an actively managed ETF, so it's not going to erode like a 3 times ETF. You're not exposed to just one sector or one market. They're going to they're managed by professionals, and you can see during the market decline, this went from about 10 to 12.50. So one reason it's fell a little more than the markets because it's short of the higher beta stocks, which I like. So I think you want exposure to being short the higher beta stocks. You know, the Netflixes, all the SWKSs. I don't know if they have SWKS. I'm just saying just in general terms. So I think the one trade that you can make right now is, let's say you're someone trading ETFs or sectors. You don't want to really pick individual stocks. If you put 20% of your money, for example, in something like this, and then 20% of your money in the gold stocks, that to me is a great pair trade. That is the trade that made a lot of money in the early 2000s, where you could have been short the market and long the gold stocks. And I'm going to show you why that in a second. This can really be summed up in one sort of chart. And the one chart is the S&P to the XAU. Now, the reason I'm using the XAU is that the HUI doesn't have the historical data that the XAU has, okay? So you can see it takes 47 shares right now of the XAU to buy the S&P. It's actually 35, but it was 47 at the top. But even this 35 is higher than we were at the 2000 top, okay? And after that 2000 top, we're going to do this below S&P price. You got to love a live video. So after this ratio got out of whack then, the S&P went from 1,500 to under 800, okay, in the next 2 years. And the XAU went from under 50 to 100. So it doubled in value. So your shorts would have made you 50% because, your shorts go from 1,500 to 750 or 800. And your longs on gold would have made 100%. So essentially in a 2-year period where, stocks went down 50%, this strategy would have made you, say you had 20% of your money in gold stocks, 20% of your money in shorts. You would have made 10% of your shorts and 20% of your gold stocks. You would have made 30% on your portfolio just putting 40% of your portfolio into this strategy. And obviously you have to use some common sense that by 2002, 2003, you could see that the market was oversold. You're in a long-term bear market. You want to take those shorts off. So you have to use some common sense. But I think what's great right now is that we have this trade set up even cheaper than it was in 2000. So I would think that right now, you're an average everyday investor. I'm not going to hide this. I'm not going to say, hey, you got to subscribe to my newsletter to do this. You got to buy the hedge fund I'm launching. I think if you did something very simple as buying the GDX, buying the GDXJ, buying the GLD, buying the central fund, the CEF, something like that, buying gold and precious metals exposure, and going short with the hedge fund, the HDGE, I think you did something, or if you want to buy a closed-end fund, an open-end fund, buy the Bear X, Do something as simple as this right now. You could really make a lot of money going forward in the market. Because what I'm expecting is if you have a dump in the market, the Fed is going to come back with QE. I don't think that's enough to save the market this time, but it's going to really hurt the dollar, and you'll see the gold and PMs kind of rally on this, right? And you can see, look at this is the up, which is a 2 times dollar index, but you can see we're getting right towards the support level here, and the dollar really looks like it could be finished. Now, and what you have to understand, you have to look at the dollar too, and again, this is kind of the way I think. And I know a lot of people are bullish on the dollar. They still think there's going to be another rally, but I look at it this way. When the Fed began to taper, you had Japan printing, Europe started their QE, so you had the Fed tapering while the other central banks were loosening. So, and you had to unwind a trade where people were short dollars, long risk assets, and the dollar began to discount the Fed raising rates while everyone else was loosening. Well, the part of this trade that needs to that needs to come out of it is them raising rates. Like, how much of this is a discounted trade that the Fed was going to raise rates? Remember, they were supposed to raise in March, then June, then September, and now December. And I really think the last employment report was kind of in the nail in the coffin for the rate raises. And, obviously we've seen this big deflationary trade in commodities and the whatnot. So this is another long trade right now that I really think that despite the fact that there's all these deflationary pressures in the world, you can look at going long commodities on top of gold, because I think the next monetary inflation cycle will be like a money printing monetary phenomenon, not because of economic boom, more like the 70s, where you have weak economic growth, but commodities go up because the central banks around the world are quite simply printing too much money. So again, we look at the CRB and we divide that by the S&P, and we can again see that we, again, are as cheap as we've ever been in commodities. So, in my opinion, not only can you go long gold and precious metals, but you can go along the base metals. A lot of these stocks are very beaten up. And what we have to understand is, my opinion is that the commodity supercycle is still intact. We go look at something like copper. Okay, copper may be at 238, down from 464, but it used to be 60 cents. Okay, now our buffer seems to be 150 to $2 is the lower end of it. We look at something like gold, and this is where I think the commodity bears on a macro level are very wrong. Now, on a micro level, these companies make terrible decisions, took on too much debt, all of this sort of thing. When we look at gold, gold was 250. Okay, now the base in gold seems to be about 1,000. You know, we look at silver. Silver used to be $3 or $4 a share or an ounce, right? Now silver, the base seems to be, $13, $14. So what I'm trying to show from all of these, oil. Oil I know it's collapsed, but now the base in oil, in my opinion, seems to be about 30 to 40. Oil was $10, $11 in late 98. So we've seen a big decline in these things, but the levels of their bottoming are, much, much lower now. Even something like cotton. Cotton used to go to 26. This is an ETF. What's the spot price? Sorry, 26. Was during the spike here, but now the base seems to be about 60. So it's kind of like we have higher highs longer term in all these things. So the commodities is something that's interesting because it's something where you could argue where the bulls and the bears have both been right in that anyone who's been bearish on commodities because of China, yeah, we've seen huge declines. You've seen stocks like, say, Consolidated Thompson, or Cliffs Natural Resources, which took over Consolidated Thompson, and Cliffs made a lot of bad decisions. This stock has gone from $100 to $3. Okay, so anyone short that stock who was a commodity bear did very well. But in the longer term, we can see there's higher basing in these sort of things. Now, of course, for trading, it's very difficult. But again, right now, I'm just showing you. This is why I want to look at the commodity markets. And also, we're in a 4-year bear market. It's very rare that a cyclical bear market lasts longer than 4 or 5 or 6 years. So I hope that what this video did is this help show you, the kind of the way I'm thinking. That I'm looking at shorting stocks that are overvalued, and fundamentally falls and have tough year-over-year comparisons. I'm actually going to give you one more example in a second. It's something I might do next year, okay? And then going long assets that are undervalued and show you why in the macro level, it looks like 2000 and we could do a similar trade to them, being long the gold and PM stocks and short the other stocks. So let me show you something here too, okay? Which I think is really interesting. We all know the airlines had earnings. Delta had pretty good earnings today. The stock is up 2%. It's had this huge run. Something like Alaskan Airlines done very well too. There's an airline ETF, the Jets, which came public around 25. But what I want to show you with these stocks, those airline stocks, is, again, I want to look for stocks that have difficult year-over-year comparisons and deteriorating fundamentals. Delta, even though it beat on its bottom line, missed on its top line today. And the gain from low oil prices is over. So I want to be short sectors that, say, have had the one-time benefit from the low oil sector, from low oil prices. Like Delta, the airlines, obviously the big beneficiary of that. The lower-end restaurant chains, because the cut in oil prices really helps the lower to lower middle class. Because, they're the people who are saving $40 a week on gas, really makes a big difference for them. So they might go spend it at a pizza joint or at a burger joint or something like that. So these are the companies I want to short because I know that year over year, the benefit of these low oil prices is gone, right? It all really happened in the fourth quarter this year. So starting in the first quarter, or the fourth quarter reports in January, they're going to have very difficult year-over-year comparisons. And this last kind of basing area or declining area in oil, people really, especially in the last 6 months, haven't really been spending their oil gains. Actually, they've been saving them. So there was initial surge, and now they're not going to really continue to spend after they got those initial gains. Psychologically, it's just not there anymore. And I think, again, these lower-end restaurants, which are mostly bubbles, like I'll show you one. I'm not short this, just so you know, but I would just show you as an example. This is Domino's Pizza, and look at the ridiculous run this is on. And actually, their last earnings were very poor because of the exposure to China. So you can see, like, this is a pizza company. Give me a break, man. These things trade at 40, 50 times earnings. Ridiculous. Look at that. Totally parabolic. Anyhow, this was $2 in 2008. And anyhow, so I want to be short these companies that had the one-time gain from low oil and gas prices, just like the Apple chip makers had one-time gains from the iPhone 5, 6, or iPhone 6, etc. So these companies are going to have very difficult comparisons year over year, and I think you'll see, for example, the airlines really struggle next year because Delta missed again on the revenue side. So if you can't grow your revenue, and by the way, I don't know if you noticed, but fares have started to come down. Americans started to cut fares, and then this is like, we're not having a huge pricing war yet, but you are definitely seeing like you can fly from Los Angeles to Miami, $300 return, and I haven't seen that in quite a while. So that's going to cut into these margins as well. So I think that when you start getting to next year, and even if oil prices stay low, the year-over-year comparisons are going to be very, very difficult for these companies, and they could really, really start to sell off. And usually when you get these busts in oil, and again, let me show you again. This is how macro I kind of think, okay? When you get these busts in oil, okay, I'm going to go back to the 80s so you can see these two busts, the big busts that have happened in oil. So the big busts happened in oil were, 86, 98. This was a spike more due to the Gulf War, so I'm going to throw that out. But the actual bust, 2008. So we've basically had 3 busts in the last 30 years. And every time you've had those busts, you've had the basing period has taken about a year to a year and a half. And we can argue we're about 8, 9 months into it. So we're probably going to see a lot of supply come off the market, especially in the frackers. And then that could probably lift us back in oil over the first half or second half of next year, probably to 70, 80. I think probably over the second half of next year. So again, that's going to be very difficult for these airlines to absorb, especially when their year-over-year comparisons are going to be so difficult. So just so you know, what we're doing is we're starting a promotion today, and the email has all the information there. But on top of my regular newsletter, the weekly updates, video updates like this, like special video updates I get to paying members, etc., etc. What we also do is I started a short selling service. So, we shorted stocks like NHC.to and CXR.to in the service. So if you want access to something like that, and there's not many short selling services around, basically, if you sign up for a 4-month subscription, you'll get that 1 month for free. And if you start up for a year subscription, you'll get 4 months for free. And that's it. So it sounds really good. I hope you enjoy that. And I'm going to charge, ultimately, by the way, $2,500 a year for that service because short selling is more sophisticated, and I want to gear it at sophisticated investors. So I hope you enjoyed this video, and it kind of showing you the way we kind of trade and look at things and think. And I think I'm being very in-depth, and I hope you enjoyed it, and I hope you become a member.